manage real estate and maintain liquidity, safety, and rates of return that are 100% greater than the debt service on the real estate. In this episode, I'm going to address the question how smart real estate investors use max-funded IUL to keep their money liquid. Get ready. You're going to gain insights into some opportunities you probably never existed before. So my name's Doug Andrew. I've been a financial strategist and a retirement planning specialist now for north of 48 years. I have absolutely loved helping people optimize their assets, minimize taxes, and empower what I call their authentic wealth. One of my favorite financial instruments is called a max-funded indexed universal life insurance contract. I call it a laser fund if it's structured correctly and funded properly. And I often compare it to a Swiss Army knife. So it's like a financial Swiss Army knife with all kinds of uses. It can be the dream solution for many things. In this episode, I'm going to talk about how many real estate investors, as they manage their real estate, use it as their working capital account and help themselves get out of debt quicker and smarter and faster and so forth. So let me give you a few insights on how you do this. If you're not aware, a max-funded indexed universal life policy, when it's structured correctly, you're taking the least amount of insurance the IRS will let you get away with under 3 sections of the Internal Revenue Code and 3 tax citations. You can search other episodes on this channel, Three-Dimensional Wealth, to learn about this. In fact, I would recommend you subscribe. It's free, and click the little bell when you do so you'll be notified every time I release a new video. These are educational, and you don't want to miss out because I release about 5 every single week. Now, IUL, when you structure it correctly, you're doing it so that your money will accumulate tax-free. You can access your money tax-free, and when you ultimately die, it blossoms, it increases in value and transfers income tax-free. That is provided under 3 sections of the Internal Revenue Code that in one form or another have been there to protect insurance for over 108 years. Now, those are sections 72E, 7702, and 101A. I explained them in other episodes. Now, the tax citations are TEFRA, DEFRA, and TAMRA, which are acronyms. So when you structure one correctly to put in the most money and take the least amount of insurance and put in the money as fast as the IRS allows, it turns into a tax-free cash cow. Many real estate investors use this as a working capital account. And this is where, if you were like my history has been, when Indexed Universal Life came out in 1997, I've averaged 9.62% rates of return. Let's just go down to 9.6. Rule of 72, you divide 9.6 into 72, your money doubles every 7.5 years. So I've had many real estate investors, as they manage that, they will take their rental income, and instead of sending it to the mortgage company to pay off their mortgage, they are savvy, they're smart. The mortgage may be at 4.5% interest, tax deductible. In a 33% tax bracket, it's a net cost of 3. So on $1 million mortgage, they're paying $30,000 in interest. And on their IUL policy, they're earning 10, let's say, netting 9, which I've done many, many years. How much more is 9% than 3%? Okay, it's 3 times as much. They're making $90,000 on that million, and they're only paying $30,000 on the mortgage. See, this is how banks operate. They pay interest when you put money in a bank or a credit union. Are they just a benevolent institution? No. They don't just stick your money in some vault. They're paying you 1%, and they're turning around and putting a lot of that into insurance companies earning 4 or 5%. What real estate investors do is they realize, if I'm using money, OPM like banks do, and I have a mortgage on my real estate portfolio or mortgages, and I'm paying a net of 3%, then I keep my money over here liquid and safe at 9%. So I'm making 3 times as much interest on my working capital account. And instead of paying down the mortgage and then they get into trouble, we have a recession, they have vacancies, they have to then refinance or borrow or sell the property, and it's a soft market. I've heard horror stories. So let's say you're a real estate investor and you do want to get out of debt. You just want to, sleep at night because they're paid off. I can prove to you mathematically, and stay with me to the end of this episode because I want to gift you a copy of one of my best-selling books that will explain this. If you want to get out of debt, and your definition of out of debt is not owing a dime to anybody, if you send extra principal payments against your mortgages to the mortgage company, you're giving up liquidity. I think you're giving up some safety of your principal because real estate can drop in value, and you're giving up the rate of return I just mentioned. And so rather than do that, you put it over into an IUL contract, and that money compounding will generate enough so that you can actually take a lump sum out of your IUL policy and pay off your mortgages about 2.5 years faster, sooner than giving the money to the mortgage company. A lot of people go, what? Yeah. Simply put, a lot of times people take out a 15-year mortgage. I'm just going to bite the bullet and pay higher principal and interest payments. I'll be out of debt in 15 years. If you took that differential between a 15-year mortgage payment and a 30-year amortized mortgage payment, you took that difference plus the tax savings you will achieve during the first 15 years of a 30-year mortgage, and you put that away systematically into an IUL policy, there will be enough money in the IUL policy to pay off the 15-year mortgage in 12.5 years, 2.5 years faster, using Uncle Sam's money to a degree instead of your own money. People go, wow. But see, if it took the same amount of time, I would do it because I like the liquid money in the IUL policy. I like liquidity in case I need the money. It's a lot easier to get it out of an insurance policy than to try to borrow it back from a mortgage company or a bank, because then I have to prove that I need it. And when I need it the worst, it's the hardest to get. Does that make sense? But let me tell you another use for IUL with real estate investors. Many times I have real estate investors that make millions, and they will use their IUL policy as a working capital account. And so they take the positive cash flow and they will put it into their IUL policy, and then they see opportunities and they see another apartment complex. And this happened in 2017. One of my clients needed $1 million within 72 hours to use as an earnest money to tie up a multi-unit apartment complex that was going to cost millions. He called and said, I need $1 million out of my IUL policy, and I could have arranged for an electronic transfer or a phone call, but he only, he said, I got a couple of days. So I sent him over the form. It's one page, and he put his name and his policy number, and he borrowed $1 million. He could have withdrawn $1 million, but he borrowed it because of this principle, arbitrage. He borrowed $1 million at 5% interest out of his policy, and they kept crediting him the indexed rate that year, which ended up being 25% in 2017. Did you hear what I just said? He borrowed $1 million and they charged him 5%. He could have borrowed it out of his policy at 2% and they would have just credited him 2%. That's called a zero wash loan, but he understands how money works. He said, I'll let you charge me higher interest, 5%, but you keep crediting me whatever the indexed rate is on that $1 million that I'm leaving in the policy. See, the insurance company is simply loaning him money using his $1 million as collateral that stays in the policy. That year, that $1 million that he left there as collateral earned 25%, 250 grand, minus the 50,000 of interest. He netted 20% or 200,000 tax-free on the $1 million while he was using it as an earnest money to fix up and flip an apartment complex. People do this all the time. One other example. I had an elderly gentleman that had his entire career, he had paid off 2 big apartment complexes. And this was his kid's retirement. And then he had a stroke and he ended up having to let some money manager, real estate manager take over. And they embezzled some of the money. There's horror stories about this. I said, sell. He didn't want to pay the capital gain. I said, sell, pay the capital gain tax, and put the net into a portfolio of insurance contracts, IUL. He goes, okay. And when I showed him, he was flabbergasted. Wow, this generates more tax-free cash flow than my rental income ever did after tax. And I don't have to be a landlord anymore, taking out the trash, fixing toilets, and evicting tenants. I go, no. He goes, what am I going to do? He was moving into his 70s. And I said, relax. Well, he had some buyers lined up, and then he got cold feet and said, well, this is my kid's inheritance. We brought his 3 children into the office. And I said, I want you to shoot straight with your father. What are you going to do with these 2 big apartment complexes when he's 6 feet under? And they went, Dad, we don't want to hurt your feelings, but we hate these apartment complexes. Probably on the way home from your funeral, the for sale sign's going up. I said, why are you leaving it to them? They don't want the apartments. They would rather have the cash. And if you put it into an IUL policy, it blossoms when you pass away. I said, children, do you want to get, $6 million from the apartment complexes and then have to pay tax on that possibly? Or would you rather have $9 million within 3 weeks after he dies, totally tax-free from life insurance? What do you think they said? Oh, we'll take the $9 million with no hassle. Hello? There's so many opportunities, whether you're trying to get out of debt or whether you want to keep the property and you want to leverage, you want to use it for working capital, or you just want to sell. Where do you put the money? After you sell, you put it into IUL and you'll end up with as much or more in tax-free cash flow. And at the end of the day, when you die, it blossoms and transfers much greater amounts of money to those that you're leaving it to. So if this is beginning to arouse curiosity, subscribe to this channel, but let me tell you, I want you to study this book. I'm going to gift you a copy. It's called The Laser Fund, LASERfund.com. Now, it's actually 2 books in one. This side is about 200 pages, 14 chapters with all kinds of charts and graphs and explanations of how max-funded IUL works. If you learn by stories, like I've just told you a few, you flip it over to this one. This is 100 pages, 12 chapters with 62 like chicken soup for the financial soul stories. One chapter on this side talks about how IUL is used for real estate management. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost and I will pay for the book. Go to laserfund.com or click on the link below. And I'll fire out a hard copy to you, but there's options there if you like to listen and learn, watch and learn. There's even an 18-hour masterclass, but check out the educational webinars that we conduct because I want to empower you for a brighter future so that not only just making money on real estate, you can also make money on the working capital as you manage your real estate.